Welcome back to the deep dive. Today we're doing something a little different.
Yeah.
Usually we look at the external world, geopolitics, technology, corporate wars. But today we are turning the lens inward. We are putting on the scrubs, snapping on the latex gloves, and walking through those double doors into the autopsy room.
Right.
But the patient on the steel table isn't a person. It is the United States economy.
And just to be clear, this isn't some routine checkup. This is a trauma unit.
We're calling this the Economic Autopsy. And I really want to set the scene for everyone listening. It is Tuesday, February 10th, 2026, and we aren't just looking at stock charts or, quarterly earnings today.
Yeah, not at all.
We are conducting a forensic investigation into a number so big, so utterly massive that it arguably defies human comprehension.
It's almost an abstract concept at this point.
But it's a number that dictates the price of your milk, the rate on your mortgage, and, the stability of your job.
We're talking about the gross national debt.
As of right now, February 2026, that number is sitting at a record-breaking $38.564 billion.
$38.56 trillion. It's a number that I think for a lot of people has lost its shock value because we've heard trillion so many times.
It's just noise.
It's just noise. But today, our job is to resensitize ourselves and you to what that actually means.
And we have just a stack of reports here from the Congressional Budget Office, the Joint Economic Committee, Treasury data and analysis from major financial institutions like Bridgewater and Goldman Sachs.
A lot of data to sift through.
And the diagnosis they are all pointing toward is, frankly, terrifying. One of our key sources, the legendary investor Ray Dalio, has moved past calling this a cycle. He's calling it a fiscal heart attack.
It's a powerful metaphor, and
Yeah.
I think it's absolutely the right framework for this deep dive. I mean, think about how a heart attack works physically.
Right.
It isn't usually a singular event that just comes out of the blue, is it?
Yeah.
You don't just, walk down the street feeling fine one minute and then drop the next.
No, it's cumulative. It builds up.
Exactly. It's the result of years, maybe decades of accumulation. Plaque builds up in the arteries. It's silent. You feel fine.
Mm-hmm.
The blood is still flowing. You might get a little winded climbing the stairs, but, you ignore it. You write it off.
Yeah, I'm just out of shape.
Right. Until suddenly the blockage hits 100% and the entire system just shuts down. Catastrophic failure.
And that's the question we are trying to answer today, isn't it? Is the U.S. economy just having some chest pains, some shortness of breath, or are we looking at a full-blown cardiac arrest?
My role today is to be the analyst. I'm going to try to look at the cold, hard numbers. I'm holding the scalpel.
Yeah.
I'm not here to talk about which political party is to blame, because as we'll see, the toxicology report shows that both parties have been feeding the patient a steady diet of debt for 40 years.
Yeah, this isn't a partisan issue.
Not at all.
And I'm going to play the skeptic. I'm the taxpayer standing in the observation deck looking at this massive body on the table and asking the questions I think you're probably thinking at home. How is this even possible? Why hasn't it collapsed yet? And most importantly, am I the one who's going to have to pay for this?
Spoiler alert, you are. But the how is what's really interesting and, frankly, what's so concerning.
Before we even make the first incision, I want to visualize the speed of this thing. Because 38 trillion sounds static. It sounds like a mountain that's just sitting there. But the data shows it's moving. It's growing.
It is remarkably alive. It's essentially a living organism that feeds on interest. And based on the data from just the last 12 months, the national debt is growing at approximately $74,378 per second.
Hold on. Say that again. Per second?
Per second. Not per day, not per hour. Per second.
That's just insane.
So simply in the time it took you to introduce the show, the U.S. government added about, $2 million to the tab?
$2 million in a few minutes. That is hard to wrap your head around.
Let's try to make it relatable. The median annual household income in the U.S. is roughly $75,000.
Okay.
The U.S. government borrows that entire family's yearly existence, all their work, all their effort, every single second.
Wow. Okay, that puts it in perspective. So let's unpack this. We need to start with section 1 of the autopsy, the forensic evidence. We mentioned the total number is over 38 trillion. But let's break that down. Who actually owes this money?
We all do. This is the part people, they try to ignore. They think it's some abstract government thing.
It's Washington's problem.
It's Washington's problem, but it's not. If you break that 38 trillion down by the population of the United States, it comes out to roughly $113,354 per person.
Per person, so that includes babies, kids, everyone.
Every man, woman, and child.
So a family of 4, 2 parents, 2 kids, is effectively on the hook for, what, nearly $500,000 of federal debt?
Correct. $450,000, roughly. Or if you want to look at it per household, it's $286,108.
$286,000.
Imagine having a second mortgage on your house, a mortgage you never signed up for, that you can't live in, but you are responsible for servicing, for paying the interest on, forever. That is essentially what this is.
But here is where the skeptic in me has to push back a little bit. We've had high debt before. We had massive debt after World War II, didn't we? The debt to GDP ratio was huge then. So why is this forensic report flashing red now? Why is Dalio calling it a heart attack now instead of, say, 10 years ago?
That's the key distinction, and it's the most important question. After World War II, our debt to GDP ratio was high, yes. It was around 119%.
So even higher than it is now, percentage-wise.
In terms of its relation to the economy, yes. But there were 3 major, and I mean major, differences. First, we had just won a war that destroyed the industrial capacity of the rest of the developed world.
Right. We were the only factory left standing.
We were the only manufacturing base left on Earth. We had a monopoly on production. Second, we had a baby boom. Demographics were completely on our side, a young, growing population ready to work and pay taxes.
Okay.
And third, and this is the crucial part, we stopped borrowing. We ran surpluses. We spent the next 30 years growing into our debt. We didn't add to the pile.
And today?
Today, the velocity is moving in the completely wrong direction. The debt increased by $2.35 trillion in just the last year.
$2.35 trillion in 1 year.
And we aren't rebuilding Europe. We didn't just fight a world war.
No, that level of borrowing is, it's usually reserved for absolute national emergencies. A total economic collapse like 2008.
Or a global pandemic like 2020.
Exactly. But in early 2026, we are not in a recession. The stock market is, arguably doing okay. Unemployment is relatively low. We are not fighting a world war.
So we are running crisis-level deficits during peacetime, during a period of, relative stability. That's it. That's the bleeding aspect of the autopsy.
Yeah.
For the first 4 months of this fiscal year alone, just 4 months, the deficit was $696 billion.
Almost $700 billion.
We are borrowing roughly $6.43 billion every single day. Not to fight a war, not to save the economy from a pandemic, but just to keep the lights on.
And this brings up a concept I think we really need to double-click on, the primary deficit. Can you explain that for the listeners? Because I think that's a vital distinction that often gets lost in the cable news shout-fests.
It is the most important vital sign on the patient's chart. The primary deficit is the difference between what the government spends on programs.
So defense, Social Security, education, salaries for park rangers, all that stuff.
All of that. The difference between that spending and what it collects in taxes. Crucially, this calculation excludes interest payments on the debt.
Okay, so this is key. Even if we had zero debt, even if by some magic we didn't owe a dime to China or Japan or anyone.
Even if we had zero debt and paid zero interest, we are still spending more than we earn. We are structurally insolvent.
That's the real bombshell here.
It's like a family that earns $50,000 a year but spends $60,000 on groceries and rent. And that's before they even make their credit card payment.
So the idea of growing our way out of it, which you hear all the time from politicians, that isn't really an option anymore, is it?
It makes it incredibly, incredibly difficult. If you have a primary deficit, growth alone doesn't fix the hole. You have to actually cut spending or raise revenue just to get back to zero, to reach the baseline before you can even start paying down the debt.
And that feels like the perfect transition to the actual potential cause of death.
Section 2 of our autopsy, the interest rate trap. This is where the mechanics of the bond market come into play and really start to squeeze the patient.
This is the part that really stood out to me in the research, and it's what has changed so dramatically in the last few years. For a long time, basically from 2008 until very recently, debt didn't seem to matter.
Because it was free. It was free money. Because interest rates were basically zero.
I remember that era. They called it the Great Moderation, or ZRE, Zero Interest Rate Policy.
Exactly. We lived through a historical anomaly. For 15 years, the government could borrow at near 0%. It's like getting a mortgage with no interest. You can borrow a huge amount, grab a mansion, and your monthly payment is still incredibly low, but that era is over. The bond market has shifted. The party's over.
So what are we seeing now in terms of the yield curve? What is the government paying to borrow?
Well, rates on Treasury bills are now averaging around 3.76%.
3.76. Now, to a consumer who's used to, 20% credit cards, that sounds pretty low.
It sounds manageable. But when you owe $38 trillion, 3.76% is a killer. It's the difference between a manageable payment and, well, bankruptcy.
And the sources say we are hitting a terrifying milestone in fiscal year 2026 because of this.
We are. This year, for the first time ever, interest payments on the national debt are projected to reach $1 trillion.
$1 trillion just in interest? That's not paying down the principal at all.
Not a single cent of principal. That is just the minimum monthly payment on the national credit card.
Let's put that number 1 trillion in context. How big is that relative to everything else we spend money on?
It's enormous.
Yeah?
That $1 trillion is now the second largest line item in the entire federal budget. It is now larger than the entire Department of Defense budget.
Wait, larger than defense?
Larger than the defense budget.
Yeah.
It is also larger than what we spend on Medicare. Think about that. We are spending more to pay off bondholders, many of whom are in other countries, than we are to defend the country or to care for our own elderly citizens.
I want to double-click on this fiscal heart attack concept again. Why does a high interest payment trigger a heart attack? Why doesn't the government just, print the money to pay it? You hear that all the time.
Because of inflation. It's the one trap you can't escape. If you just print money to pay the interest, you devalue the currency. You flood the system with dollars.
Which causes prices to go up for everyone.
Precisely. It causes inflation, which then causes interest rates to go even higher because lenders, the people buying our bonds, want to be compensated for that inflation. They're not going to lend you money at 4% if inflation is 8%.
So printing money just makes the problem worse. It's the definition of a death spiral.
It is. It creates a feedback loop that's almost impossible to break. And there is a mechanism here that's really accelerating things right now. It's called refinancing risk, and I can guarantee you it's keeping people at the Treasury Department awake at night.
Okay, break that down for us. It sounds technical, but I have a feeling it's crucial.
It's absolutely crucial for you to understand. The U.S. government debt isn't like a 30-year fixed mortgage where you lock in a rate and then you forget about it for 30 years.
You would think, oh, they borrowed all that money when rates were zero, so we're good.
That's what a lot of people assume. But we aren't good. A huge chunk of our debt is very short term. The data shows about 33% of all our public debt matures in the next 12 months.
1/3. So 1/3 of that $38 trillion comes due this year.
Yes. That's what Wall Street calls the maturity wall. And since we obviously don't have the cash sitting around to pay it back,
We have to borrow new money to pay off the old money.
exactly, we have to roll over the debt. But here is the trap. The old money, the stuff that's maturing now, was borrowed when rates were, say, 0.5% or 1%. The new money we're borrowing to replace it is being borrowed at nearly 4%.
So we are literally paying off a 1% interest credit card with a 4% interest credit card.
Trillions of dollars of it.
Yeah.
We are repricing the entire debt stack at a much, much higher rate. This is why the interest payments are exploding skyward even if we don't spend a single dime of new money. The old debt is just getting more expensive.
And this, I assume, leads to another term I hear a lot in financial news, but it usually gets glossed over, the crowding out effect. What does that actually look like in the real world for you and me?
Imagine the economy is a giant swimming pool of available money, of capital. That money can go to startups, it can go to building new factories, it can go to R&D for a tech company, or it can go to buying government bonds.
Okay, so it's a finite pool of money.
It's a finite pool. When the government needs to borrow $2 or $3 trillion a year just to stay afloat, it sticks a massive industrial-sized hose into that pool and just sucks out the liquidity.
So there is less water left for everyone else.
A lot less. If you are a small business trying to get a loan to expand your bakery, you are now competing directly against the U.S. government for that same pool of cash.
And the government is a much safer bet for a bank.
It's the safest bet in the world. The government is willing to pay 4% or 5% completely risk-free. So the bank looks at you, a risky small business, and says, well, to justify lending to you instead of the government, I need to charge you 10% or 12%. It makes capital expensive for everyone. It suffocates the private sector.
Which slows down the economy, which then lowers tax revenue, which then increases the deficit and the debt.
And the spiral tightens. This is what they mean when they say the bond vigilantes are coming back to haunt
For
us.
bond vigilantes, that sounds like a bad 80s action movie.
It's a term that was really popular back in the Clinton era. It refers to bond traders who act as a check on governments. If they think a country is spending too much, being fiscally irresponsible, they punish them.
How do they do that?
They sell that country's bonds. Or they just demand a higher interest rate to buy them. They effectively hold the government hostage and say, get your house in order, or we're going to make it really, really expensive for you to borrow.
So for 20 years, with rates at zero, the vigilantes were basically asleep.
They were asleep. They didn't have any power. But they are wide awake now. And they're looking at our balance sheet, and they're demanding higher yields because they see the risk. They see the bleeding.
Okay, so let's move to Section 3, the toxicology report. We've looked at the body, which is the debt. We've looked at the potential cause of death, the interest rate trap. Now we need to look at what the patient is actively ingesting. And this brings us to the politics of it all and the fiscal year 2026 budget.
This is where we see a radical, and I mean radical, realignment of national priorities. The budget numbers coming from the Trump administration tell a very, very specific story about where the country is heading.
Let's start with the winners and losers. Based on the proposals, who is getting the money?
The clear, undisputed winner is the Department of Defense. The proposal adds $113.3 billion to their budget. That brings the total to $961.6 billion.
Almost $1 trillion. It's just incredible.
It's inching toward that trillion-dollar mark all by itself, yes.
And what are we buying with that extra $100 billion? Is it going to, salaries for troops or better health care at the VA?
Not primarily, no. The sources we've reviewed highlight a few key areas. A big one is something called the Golden Dome Missile Defense Shield.
Like a new version of Star Wars.
Essentially, yes.
Yeah.
A high-tech, layered defense system. There is also heavy investment in space defense, the Space Force, and next-generation fighter jets. It's a very clear strategic move toward what you might call Fortress America. The logic is high-tech deterrence.
Okay, and it's not just the DoD. The Department of Homeland Security is seeing a massive bump too, right?
A huge bump, a 64.9% funding increase. And according to the budget documents, that is targeted almost exclusively at border security and what the administration itself is calling a mass removal campaign.
So defense and border security are way up. But to pay for that, or at least to try to pay for that, who is getting cut? Because looking at these numbers, these cuts look deep.
They are historic. I don't think that's an exaggeration. The State Department is facing an 83.7% cut.
83.7.
Yes. Their budget would drop from $58.7 billion down to just $9.6 billion.
Let's just pause on that for a second. 83%. That's not a trim, that's an amputation. The skeptic in me says, well, okay, maybe the State Department was bloated and inefficient. But looking at the sources, what is the economic argument for a cut that drastic?
The argument is based on a philosophy of transactional diplomacy. The budget sources and the commentary around them suggest that the administration views traditional aid, embassies, cultural programs, soft power.
All that diplomatic stuff.
They view it as a loss leader that never generated a tangible return on investment for the American taxpayer. The philosophy here seems to be that military hardware, the Golden Dome, the fighter jets, creates domestic manufacturing jobs and provides tangible, measurable security. Soft power is viewed as an intangible luxury we can no longer afford.
So it's a strategic shift from exporting influence to building assets.
That's a great way to put it, correct. But the toxicology report shows a potentially dangerous side effect to this strategy. If you cut the diplomats who negotiate trade deals and security pacts and de-escalate conflicts,
you eventually have to use that expensive military hardware you just bought.
Exactly. It's a high-risk gamble. You're basically trading your insurance policy for more firepower.
Okay, who else is on the chopping block in this budget?
HUD Housing and Urban Development is facing a 43.6% cut. This completely eliminates the community development block grants, which fund a lot of local infrastructure projects, things like roads and community centers.
So that hits cities and towns directly.
Directly. The Department of Education is looking at a 15.3% cut, which aligns with the administration's stated goal of eventually shutting down the department entirely. And the social safety net is taking a significant hit. Our sources point to major cuts to rental assistance programs and LIHEAP, the Low-Income Energy Assistance Program.
So we're treating diplomacy and social programs for missiles and border agents. But here's the billion-dollar question, or I guess the trillion-dollar question. Does this balance the budget? Do these cuts even come close to paying for the increases and the debt?
The math says no, not even close.
Yeah.
And that brings us to the other side of the ledger. The One Big Beautiful Bill Act, or OBBA.
OBBA, that's a catchy name.
It was signed in July of 2025. And it did two main things. It extended a raft of previous tax cuts that were set to expire, and it added some new ones. Now, the administration claims that new sweeping tariffs will generate enough revenue to offset these tax cuts.
And what's the projection on that? How much do they think the tariffs will bring in?
They are projecting about $145 billion a year in new tariff revenue.
$145 billion. But didn't we just say that the interest payment alone is $1 trillion this year?
Exactly. This is where the toxicology report shows the patient is knowingly continuing to ingest fiscal poison. $145 billion is a drop in the bucket. It doesn't even cover 15% of the annual interest bill.
So it's not even a rounding error, but it's close.
It's close. Meanwhile, the Nonpartisan Congressional Budget Office, the CBO, projects that OBBA, the tax cut bill, will actually increase the debt-to-GDP ratio by 29 percentage points over the next 3 decades.
So let me get this straight. The plan is we are cutting revenue through tax cuts, we're increasing spending on defense and interest, and we're hoping that tariffs, which are essentially just taxes on consumers, will somehow plug a multi-trillion-dollar hole.
That is the strategy on paper. And the market, the bond vigilantes we talked about, they were looking at that math and they're saying this doesn't add up. This is not a serious plan. This is why bond yields are staying high. The market knows there is no real plan to actually balance the books.
This feels like we're driving 100 miles an hour toward a cliff, and the people in the front seat are arguing about what song to play on the radio. But there is another layer to this, a potential systemic failure. Section 4, the war on the Fed.
This is arguably the most dangerous part of the entire diagnosis. The open conflict between the White House and the Federal Reserve.
Set the scene for us. We have the president who desperately wants lower interest rates to juice the economy and, frankly, make that debt problem look cheaper.
Right.
And you have Jerome Powell, the Fed chair, who is trying to keep inflation from coming back and exploding.
That's the fundamental conflict. The president looks at that $1 trillion interest bill and says, lower the rates. If rates go down, our payments go down, which is true in the very short term. But Jerome Powell is looking at the bigger picture. He's looking at inflation. He knows that if he cuts rates too fast, especially with all these new tariffs driving up the price of imported goods, inflation could roar back to 8 or 9% in a heartbeat.
So they are at a complete standoff, and the rumors coming out of Washington are getting pretty wild.
They are. There is open discussion, reported in multiple sources, about the White House trying to find a way to remove Powell from his position before his term officially ends in May of 2026.
And they even do that.
It's legally very murky, but the threat itself is damaging. Or, even more bizarre, there's this shadow chair idea.
A shadow chair? That sounds like something out of a spy novel. What on earth is that?
It's a concept that was reportedly floated by Scott Bessent. The idea is to appoint a successor to Powell early way before his term is up. The White House would basically announce, this is the new guy. He takes over next year. Listen to him. The goal is to make the market start pricing in the shadow chair's dovish views instead of the actual chair's more hawkish stance.
It's a way to undermine him without actually firing him.
Exactly. It's an institutional power play.
Why is this so dangerous? I mean, for the listener at home, why should they care if Jerome Powell gets pushed out or undermined? It's just politics, right?
No, it's so much more than that. Because the entire global financial system is built on one thing. Trust. This is the whole concept of central bank independence. Investors all over the world buy U.S. debt. They lend us money because they trust that the Fed is an independent, non-political institution. They trust that it won't just print money to bail out the president's political ambitions.
And if that trust goes away?
If the Fed becomes just another political arm of the White House, that trust evaporates overnight, and the value of the dollar could go with it.
This connects to a concept called fiscal dominance, right? Can you walk us through what that means?
Exactly. Fiscal dominance is a terrifying economic state to be in. It's the point at which a government's debt is so high that the central bank loses its ability to fight inflation. They have to keep interest rates low to prevent the government from going bankrupt, even if inflation is skyrocketing.
So the Fed, our central bank, effectively becomes a hostage to the Treasury and its spending habits.
Yes, they are no longer independent. Their primary mission shifts from price stability to financing the government's debt. And once you reach that point, historically you see massive currency devaluation and hyperinflation.
And the market reaction is already happening, isn't it? People are hedging. Look at gold.
Gold has been on an absolute tear. In early 2026, it has surpassed $4,600 an ounce. That is a massive rally. And it's not just, retail investors buying coins.
It's central banks.
It's other countries' central banks.
Nice.
Germany, Italy, many others are actively repatriating their gold, physically taking their gold bars out of U.S. vaults in New York and London and bringing them home.
That feels like a powerful vote of no confidence.
It is the ultimate vote of no confidence. It's a hedge against the U.S. dollar. And we're seeing the dollar itself weakening against the euro and the yen throughout late 2025 and into this year. This all connects to something called the Triffin dilemma.
Oh, I love a good dilemma. This is one of those concepts that gets thrown around in finance circles, but let's break it down for the listener who isn't a macroeconomist. What is the trap here?
It's the fundamental paradox of being the world's reserve currency. Think of the U.S. dollar as the world's financial operating system.
Windows for money.
Exactly. For global trade to work, there need to be enough dollars in circulation for everyone to use, for Brazil to buy oil from Saudi Arabia, for Japan to buy wheat from Canada. It all happens in dollars.
Which means the U.S. must run a trade deficit. We have to send more dollars out into the world than we bring back in so the world has liquidity to work with.
Precisely. If we suddenly ran a surplus, if we exported more than we imported, we would be sucking dollars back into the U.S. and the global system would seize up and run out of cash. So, to be the king of currencies, we are structurally forced to run deficits. We have to provide the world with our currency.
But, and here is the dilemma, running constant massive deficits eventually makes the world question the long-term value of that currency. That's the trap. To support the world, you must be fiscally irresponsible, to a degree. But if you are too irresponsible for too long, the world fires you from your job as the reserve currency holder. And we are currently testing the absolute outer limits of that paradox.
So this war on the Fed essentially signals to the world, we might not care about the stability of the operating system anymore. We're willing to risk it for short-term political gain.
That is exactly the signal it sends. We are damned if we do, damned if we don't. We need to borrow to maintain our global status, but the borrowing itself is what's killing that status.
And right now, we are doing it to the tune of $38 trillion and counting.
Mm-hmm.
Okay, I want to bring this home. This is the most important part. Section 5, the human cost. Because right now, there is a listener out there thinking, okay, 38 trillion, bond markets, shadow chairs.
Mm-hmm.
That sounds like high finance stuff. I'm just trying to pay my grocery bill and get the kids to soccer practice.
Mm-hmm.
Why does this hurt them? It hurts them directly, and in ways they might not even realize. It's not just some number on a screen in Washington. Let's start with the most expensive thing most people will ever own, their home.
Mortgage rates.
Mortgage rates. Mortgage rates are not set in a vacuum. They are loosely pegged to the yield on the 10-year U.S. Treasury bond. If the government has to offer 4.5 or 5% to get people to buy its debt, banks have to charge you 7 or 8% for a mortgage just to make a profit.
So government borrowing directly sets the floor for consumer borrowing.
It sets the floor. Let's put a number on it. Our analysis of the data shows a typical mortgage right now costs about $500 a month, more in interest than it did in 2019 for the exact same priced home.
$500 a month.
That is $6,000 a year of your disposable income just vanished into thin air to pay the bank. That's money that isn't going to college savings or a new car or dinner at a local restaurant.
$6,000 a year, that's a car payment, that's a family vacation, that's a whole year of groceries for some people.
Exactly. And speaking of groceries, let's talk inflation again. We've touched on it, but let's be clear. High deficits plus high tariffs is a recipe for persistent inflationary pressure. The government is pumping money into the economy through borrowing, and the tariffs are raising the cost of imported goods at the same time. So the cost of living stays high. You're paying for that national debt every single time you go to the checkout counter.
So it's a double whammy. Higher borrowing costs and higher prices for goods. And what about the future? We talked about this fiscal gap. What would it actually realistically take to fix this mess?
This is the hard truth that no one in politics wants to talk about. The fiscal gap analysis from the CBO shows that just to stabilize the debt, not even pay it off, just to stop it from growing relative to the size of the economy, we would need immediate permanent changes equal to 2.9% of GDP.
Okay, what does that look like in real money? 2.9% of GDP sounds abstract.
It's about $827 billion a year, every year, forever.
827 billion. How do you get there?
Well, the math gives you a few options, and all of them are politically toxic. You'd have to hike all federal income taxes by 34% immediately on everyone.
A 34% tax hike, that's political suicide. It's impossible. No candidate would ever even suggest that.
Or on the other side, you'd have to cut all non-interest spending by 14%.
All spending. So that means cutting Social Security, Medicare, the military, everything across the board by 14%.
Everything. That's also political suicide. No one will vote to cut benefits for seniors or military pay.
So if we can't raise taxes that much and we won't cut spending that much, what's left? What happens?
Then the most likely outcome is the one that's already happening quietly. It's what economists call financial repression.
And what does that mean?
It means we just keep inflating the currency. We don't have a big crisis. We just let inflation run hot, maybe 4% or 5% a year for a decade or more.
Which eats away at the real value of the debt over time.
Yes, it makes that $38 trillion worth less in the future. But it also eats away at the real value of your paycheck and your savings account. It is a hidden stealth tax on every single person who holds dollars. The listener pays for the debt through a quietly, gradually lower standard of living.
So let's wrap up this autopsy. The patient is on the table, the chest is open, the arteries are clearly clogged with debt, the heart is straining under the immense pressure of these interest payments. What is the final prognosis?
The patient's still alive, but they are in critical condition. The vital signs are flashing red all over the monitor. The debt-to-GDP ratio is nearing 120%. Interest costs are now more than defense spending, and the next milestone is right around the corner. It's not years away.
We are projected to hit $39 trillion by April 2026. That is roughly 150 days from when we are recording this.
It's relentless.
Yeah.
The power of compounding interest is taking over. The debt is now feeding itself.
I want to leave the listener with a final provocative thought to chew on. For our entire lives, we've always assumed the US dollar is invincible. We called it the exorbitant privilege. We can borrow whatever we want, spend whatever we want, because we're America. Because at the end of the day, who else are you going to trust with your money?
But history is just a graveyard full of empires that thought the exact same thing. The Spanish Empire, the British Empire, the Dutch. They all had the world's reserve currency until one day they didn't.
And with the political instability we're seeing, the open attacks on the Fed's independence and this mathematical debt spiral where we are now borrowing just to pay the interest.
Yeah.
Have we finally actually reached the limit?
That's the haunting question, isn't it? If the world stops buying our debt, if Japan and China and Europe and the oil producers finally say, no thanks, it's too risky, who picks up the tab? Who is forced to buy all that debt?
The answer might be the person listening to this right now. Through your 401k, through your taxes, and through the price of your milk.
Knowledge is the best defense. Keep watching the numbers. Don't let the day-to-day headlines distract you from the long-term trend lines.
Thanks for joining us on the Deep Dive. This was a heavy one, I know, but a really important one. We'll see you next time. Hopefully with a healthier patient, but I wouldn't bet on it.
We can always hope.
Take care, everyone.